Real estate is facing a crisis. Over the past year, we've seen interest rates increase and property values continue to go up, making home ownership seem impossible for most people.
Home prices hitting another high.
Home prices have been rising again for several months.
And it's more than double from 2 years ago.
Higher mortgage rates, which are near a 22-year high.
That leads us to a very powerful question. If most normal people can't afford to buy a home, then who's actually going to be buying them? Well, I found a very interesting video about this topic from one of my favorite YouTube channels, and I want to share my thoughts about it. So let's hop on in.
Fewer young people than ever are going to be able to buy a house in their lifetime, and at the same time, homes are getting more expensive every year. But if nobody can afford to buy a house, then how the fuck do they keep getting more expensive?
Especially in places like the Bay Area, where housing prices are continuously increasing year after year.
Being able to save a 20% down payment is almost unimaginable.
For most people, 20% down is like a lifetime saving in and of itself. And for like a Bay Area home that costs $1 million, you need $200,000 just to put down for the down payment, and it doesn't include closing costs. It doesn't include some reserves that most lenders need. So yeah, you definitely need to save a lot to buy a home.
Rent gets raised, 1,000% with no notice. And
to be fair, most increases are going to be under 10%, and there are definitely some laws out there that prevent your rent from increasing beyond a certain amount.
Owning a home with a 30-year mortgage is cheaper out of pocket every month in most cities than renting. So if you can buy your own home, you will be richer now and richer in the future.
And that's why we love buying real estate, because we get to have the appreciation from the equity. And for rental properties, our tenants are actually paying our mortgages. So we're actually earning equity and cash flow by buying these properties.
But if you're in the 75% of my audience that doesn't own a home, it's probably because you can't afford one. According to a report by Redfin, only 21% of homes that went on sale in 2022 were considered affordable. That's down from 60% of homes that went on sale in 2021.
So 1 in 5 homes for sale in 2022 was affordable, whereas in 2021, 40%. That's a very interesting statistic, and I believe the reason is that interest rates have increased significantly. So when people are buying homes, it's usually based on how much income they make. Most lenders would determine if you can qualify for a loan based on your debt to income ratio, and if the prices stay similar, but interest rates increase significantly, then your monthly payments are going to be higher, and therefore you won't be able to afford these homes, even though the prices are the same. And yes, this difference is because interest rates have doubled since 2021.
Houses do not need to be affordable for you to buy one. If you think that can't make sense, there is an entire industry working to make it true. You don't save money to buy a house. You save money for a down payment.
The housing costs are completely out of line with wages.
Wages have not kept up with house prices, but a 20% down payment only grows at 1/5 the rate in absolute terms, so people are still able to get into the market.
While yes, most people do save 20% for a down payment, but you can actually get into a home with as little as 3% down with a conventional loan. And that's why actually a lot of real estate professionals encourage people to get into homes with lower down payments, even though they have to pay PMI, because at least it lets them get into the home, start gaining appreciation and equity.
According to Zillow, the average home sold in America in 2020 traded for $230,000. At the start of 2023, the average home price was $330,000, a jump of $100,000 in less than 3 years.
And for most people watching this in California, you would wish and pray for a home that's only $330,000.
According to Forbes, the average American makes a salary of $59,000 before tax. After federal tax and FICA, that leaves them with a take-home of $49,000. If this average person saved a ridiculous 70% of their take-home pay to buy a house, they would be just as far away from their goal after 3 years because the price of the average house grew just as fast as their savings.
Because home prices actually increase with inflation. And this is why we actually like investing in real estate, because when you buy properties, then the value of the homes increase with inflation, as well as the rent that you get to take home.
But most people only save for a down payment. So 70% becomes 14%, or 7% if it's a dual income household where the other partner also earns the average salary. That's still a major savings commitment when 57% of Americans can't afford a $1,000 payment without taking on debt.
I would say the best situation here is to try to find a job in a high cost of living area and then moving and buying a home somewhere else. And actually we did something like that. We were from the Bay Area, we made good money there, and now we live in Texas, where the home prices here are about 1/4 of the home prices back in the Bay.
A report by the National Association of Realtors found that the average down payment for a first-time homebuyer was just 7%, and the average down payment for a repeat purchaser that has had time to build equity in their previous home was only 17%. If you only need to put a tiny deposit down, house prices can increase to many multiples of your income before it becomes impossible to buy a house. If you only need to save for a 7% down payment, then just a 10% savings rate over 3 years from an average wage would get you into an average house. You would be more disciplined than the average American, but it's not impossible with some sacrifice.
Being able to finance a property versus having to buy them with cash. See, if all of real estate had to be purchased with cash like we do when we buy something at a grocery store or we can go shopping for clothes, then I think home prices as a whole would be lower because most people just don't have that amount of savings on them. But because we're allowed to finance them with 20% down, 10% down, 3% down, then more people can bid on a certain property and increase the price.
If that's still too hard for you, then Zillow recently announced that they would be trialing a 1% down payment loan product to help people that couldn't save any money make the biggest financial commitment of their lives.
So a 1% down payment would mean that people would be able to bid each other higher and higher and higher because they only need to put down 1%. So this would increase prices and would not help their situation because people are outbidding each other all the time.
Houses can keep on getting more expensive even when nobody can afford to buy them is because nobody is selling them.
But we also don't have anyone putting their home on the market just because they have a 30-year fixed rate below 3%.
And that's a big problem. People like myself who own properties with very low interest rates have no incentive to sell their homes because then if I buy another property, I'm gonna have to pay more money for less home. It doesn't make any sense.
According to data from the National Association of Realtors, 6 million homes were sold in 2021. But now only 4 million homes are selling at an annualized rate. Potential sellers with a home loan don't want to sell because the rental market is even more unaffordable. And if they move into a new home, they will get a new home loan that has a much higher rate than what they are paying currently.
Interest rates on owner-occupied properties is 7.5%, and interest rates for an investment property can go as high as 8.5%. So it really makes no sense to sell a property just to buy another one with a higher interest rate.
Many people already moved during COVID, and another move so quickly would be too disruptive on their social and family lives, in addition to the significant interest expense of new home loans.
Not to mention the closing costs associated with selling a home.
The average number of people living in a household also increased recently for the first time in 160 years after a long trend of smaller families and people choosing to move out into their own homes. According to Pew Research that published this report, this was because more younger adults were choosing to, or being forced, to live with their parents for longer to avoid living in an unaffordable housing market.
And honestly, there's nothing wrong with staying home and saving some money. This way, you can build your net worth, and you can also build very nice connections with your family.
There are 3 groups still in the game. The first group are all cash buyers that have money from selling their old home and want to buy a new one.
I would say we're in this group right now where we're fortunate enough to have enough cash to purchase more properties. Honestly, with interest rates being at 7 and 8% for investment properties, it just really isn't worth financing it when I knew that just 2 years ago, that was what hard money lending rates were at.
Unaffordable housing is pushing people out of expensive cities across the country. You would probably prefer to stay in your home city even if you had a job that you could do from anywhere. Closeness to friends, family, and familiar amenities is why people only live 18 miles from their hometown on average.
Or if you're like someone like us who doesn't need to live in a location to work, you can live anywhere. And actually, my wife and I plan on doing that sometime this year. We're gonna fly to Taiwan, live there for a few months, then maybe hop around other places in Asia and continue doing content like this and working on our business. Because why stay in America if you don't need to?
You can improve your lifestyle by moving to cheaper cities with lower rents and property prices. If you move from a city like San Francisco, Seattle, or New York to any other city in the country, you are going to be able to buy a lot more house for the same money.
Like I mentioned earlier, our property here in Texas is about 1/4 of the price of my home back in the Bay Area. So we can get a lot more home for a lot less price. And the same goes if you move from Dallas to say somewhere in Tennessee, or from Tennessee to say somewhere in Southeast Asia. So there are many ways that you can live if you're able to, make money and earn without being fixed to a location.
Your higher income from working in these areas will push up local prices. And in the process of avoiding the rising home prices, you have just made it worse.
And that's why a lot of people in Texas hate Californians.
The third group are investors. Investors only care about the return on their assets. Prices are high right now, and investors using financing to buy property are also paying higher interest rates, but in return, they are charging higher rents to long-term tenants and short-term vacationers if they list their properties on sites like Airbnb.
I would say right now, we personally aren't seeing a huge increase in rents. I think there are a lot of companies out there who are building new properties, new developments that are actually taking some tenants away from us. So I haven't seen our rents increase too much on the long-term front, but it's definitely true that to kind of combat this weird real estate market, you kind of have to change your strategy, which is why we start getting into more furnished rentals, midterm rentals, and Airbnbs. And yes, some people might hate us because we are killing the supply of the area, but at the end of the day, it's a business, and you do make more return from short-term rentals and fully furnished rentals than long-term rentals at this moment.
Institutional investors buying up stock for real estate investment trusts were the fastest growing group of investors. Real estate investment trusts, or REITs, work like index funds for real estate.
I would have to say though, REITs are mostly for larger commercial spaces, like a portfolio of 100-unit hotel buildings. They're not really for these single family homes as a big portfolio. It's just like too much hassle to deal with them one at a time.
They buy a portfolio of properties using money collected from a large group of investors. REITs are sold both over the counter through companies like Blackstone for high net worth investors or as exchange-listed securities for average people.
I do know that Blackstone does have a big, real estate component to them where they do buy single family homes and they just buy them off, or they work with companies like Open Door, buy people out, and then just own whole blocks of single family home rental properties. But yeah, normally these REITs are for these larger commercial developments.
REITs used to focus on commercial real estate like shopping malls, hotels, warehouses, office buildings, and farmland.
And one thing to note too, a lot of the financing for commercial properties is very different from getting a loan for a regular home. See, with a regular home, you can get a typical 30-year fixed mortgage, no problem. But for commercial buildings, these are usually going to be loans that are on 5-year terms. That means that after 5 years, they have to refinance and get another loan, or their loan terms will just change and become adjustable.
This is why the market is largely resisted to sell off and why it's still possible for home prices to go even higher, even though it kind of makes no sense.
An updated Redfin report has revealed that investor purchases have slowed significantly, and surveys from local agents in cities like Las Vegas, Austin, Miami, and Houston revealed that institutional purchases have stopped completely.
I remember about 2 years ago, I made a video about Zillow's home buying division completely shutting down, and we kind of knew that this was going to be the beginning of the end for these e-buyers who would just send out all these blasts of offers for people to buy their homes cash, because originally their plan was to buy them, renovate them, and sell them, basically flipping on a large scale. But as we've seen, it didn't really work out too well for them.
Blackstone, not to be confused with the investment index company BlackRock, had to block investor withdrawals from its $71 billion earlier this year, sparking concerns that the whole system was overvalued. If investors pull their money from these trusts too quickly, the investment managers, in this case Blackstone, will be forced to sell one of their properties in their portfolio. BlackRock was accused of overestimating the price of the properties it had in its portfolio, but that's hard to prove until it's forced to sell one of them. But as soon as just one property needs to be sold, all other comparable properties in that trust need to be readjusted to a similar value. A sharp drop in the value of the trust could trigger more investors to withdraw their funds, causing the manager to sell more properties, pushing down prices even further.
And this is one of the downsides of residential real estate. Residential real estate is valued based on comparables. If you want to buy a property, then the way that we value it is based on the sale of homes around the area that have a similar size and shape to it. So, similar bedroom, bathroom, as well as square footage. So if home prices in this area are going down, then naturally the value of your home is also going to go down. Whereas for commercial real estate, it's based on your income. So as long as the property's income can stay high and increase, then even though one property sells for a little bit less, it won't really affect the commercial real estate itself. This is where things get a little bit tricky on the investment front.
The bonus fourth reason is that wealthy families are just doing a better job of holding on to more properties for themselves. In the past, family wealth struggled to get past the first 2 generations. But now that investing has become so easy and lucrative, we might be starting to live in a new age of nobility where family dynasties can last centuries.
And this is why we invest in real estate, because we believe that it is a very good long-term asset. Long after I stopped making content on YouTube here, and long after we continue doing business online, our real estate portfolio is going to continue carrying us way past retirement and even provide generational wealth for our whole family. So that's why we like this asset. And even though it might be scary for the next few years, we do believe it is a good time to always learn about it so that when you are ready for it, when you think you have enough savings and can jump into it, you'll be able to get into it without any of the hesitation. So I really like this video, and I think it accurately describes the current housing crisis here in the US. I feel like the main way to get around this is to find a way and position yourself to earn income, but also be okay with living in an area with a low cost of living. I think a lot of people are stuck in their ways and they absolutely have to live in expensive areas like New York, Los Angeles, and the Bay Area, where nowadays with remote work, you're able to make money, you're able to create side hustles, but live somewhere else. So I highly recommend you look into this and figure out a way and create a plan of what you want to do to eventually purchase real estate in the future. If you do, I definitely recommend checking out this video over here where I talk about how I would invest in real estate if I were to start over. And of course, if you want to see the full video by Hard Money Works, I'll leave it down to the link in the description. Thanks so much for watching, guys. I appreciate you, and I'll see you next time. Take care.